All right, KJ. So it's past Thanksgiving. It's December 1st. And I just announced to my family at Thanksgiving dinner that, hey, I'm going to be buying my very first private jet. The election's over. My candidate won. I can't wait. So here we go. It's December 1st. Is it too late for me to buy a private jet?
Well, Tom, it might be.
Hello, everybody, and welcome. My name is Tom Lelyo. I'm your ultimate jet guide. And on this channel, we pull back the curtain on private aviation to help you, whether you're a buyer or an aspiring broker, buy and sell private jets with no experience necessary. Today, we're tackling the exciting world of aviation taxes. Let's go. And so I am bringing on an expert from Aviation Tax Consultants. This is KJ McCarter. KJ, welcome to the podcast.
Thanks, Tom. Appreciate having me on again.
Yeah, for sure. Well, frankly, what happened was we were just kind of hanging out and scrolling, and I came across an article that someone at your shop was sharing about the 60% bonus depreciation for 2025 aircraft deliveries. And I had some questions on it. I was like, okay, so if I buy an aircraft in 2025, do I get 60%? And then it was talking things like words like place in service and year end and all this fun stuff that I'm just like, I don't know what's going on. So I wanted to get a chance to speak with you and just kind of pick your brain on this whole thing. And thank you very much to you and Aviation Tax Consultants for putting that article out there.
Yeah. Kyle Kamen from our office prepared that article and did a great job with it. It does a good job touching base on basically the difference between placing a plane in service before the fourth quarter of the year versus within the fourth quarter of 2024, because there's a little bit more depreciation available potentially if we place the plane in service prior to the fourth quarter beginning versus if we wait until after September 30th. However, a really important piece to discuss here too is just the fact that if we want to take any deductions in 2024, we need to place a plane in service before year end. So it's very, very important. Even if you don't close before September 30th, it's important that you close before December 31st and also place the plane in service, which we can discuss what that means, prior to year end if you want to depreciate the plane in 2024. Because if you close in 2025 and place the plane in service for tax purposes in 2025, depreciation deductions will begin in 2025.
Right. All right. So let's pull back the curtain here and start from the very beginning. First and foremost, this idea of buying a jet for tax purposes basically boils down to, if I buy a private jet, I can write off all or part of the purchase against my taxable income. And so for the last few years, it started off I could write the whole thing off at 100%. And then I believe 2 years ago went down to 80%. This year we're at 60%. So if I buy $1 million jet, I can write off 60% in that year that I buy it. And then the rest of that 40%, I can write off over a longer period of time. Do I have it right so far?
That is a very important piece to remember, is that we are at 60% bonus depreciation in 2024 generally now. It's scheduled to phase down to 40% in 2025 and down 20% each year thereafter, but you're not losing that amount. So when we take 60% bonus depreciation, we're not losing the other 40%. We're just taking it over a 5-year maker's schedule.
Gotcha.
40% bonus depreciation in 2025. The other 60%, we're taking over a 5-year maker's schedule. So we're still getting everything. It's just over a slightly longer period of time. So bonus depreciation, in a way, the name is kind of a misnomer. We're not getting extra depreciation. We're just getting it faster.
Gotcha. And so no matter what, is it always going to be a 5-year depreciation after you take the bonus part?
For a Part 91 plane, 5-year makers is the accelerated schedule that we use for the remainder of the basis.
Gotcha. Okay, cool. But, earlier this year, I heard some rumblings around the aviation world that we could potentially be coming back to there was laws trying to get passed, I think past the House, if I remember correctly, to try to bring back a higher bonus depreciation. Do you have any updates on that?
So that passed the House, but unfortunately was voted against by the Senate. So we're back to square one with bonus depreciation generally phasing down 20% each year, unless there is new legislation after November, which some parties in our industry are hopeful that will get done after November, but we'll see. So as of now, the current schedule is we'll have 40% bonus depreciation in 2025, 60% for 2024, and then of course Section 179 is still an option as well.
Gotcha. Okay, so I want to buy a plane to take a write off. Now, part of what the article discussed was the idea that if I buy a plane before September 30th and put it into service before September 30th, there may be advantages as opposed to buying it after September 30th. So if someone's finding this video just, on a whim and it's no longer 2024, talk to me, or maybe they're finding it, right now and they're about to buy a plane and we drop this on September 29th, who knows? What's the advantage of buying before September 30th and what happens after September 30th?
Yeah, the bottom line is if we place the plane in service before September 30th, we get to use a slightly different maker's schedule based on that place in service date. So we can actually write off, if we're taking 60% bonus depreciation as well, we'd write off about 68% of the basis in 2024 versus if we place the plane in service after September 30th, then we'd write off about 62%, depreciate about 62% of the basis in 2024. So we lose about 6% if we place the plane in service after that date. So it's important, if we want to maximize the amount of depreciation that we take in 2024, placing it in service before September 30th would be helpful.
6%. That's only about $60,000 on $1 million purchase. So that's chump change, for some people.
Yeah, the much more important date is December 31st. Because
let's roll into that.
Yeah. If we place the plane in service in 2024, even if it's in December, we still get to take 60% bonus depreciation. We get that 62% total depreciation in 2024 with the remaining 38% basis to be depreciated over a 5-year maker's schedule, versus if we wait until January 2025, then we don't get to depreciate the plane until 2025. So we don't get the deduction in 2025. We'll only have 40% bonus depreciation as of now. So not only do we have a 1-year delay in when we get to actually take the depreciation on the plane, we also have a lower bonus depreciation rate. So it's important for tax motivated buyers that have lots of taxable income from their business in 2024 to get the process started with the aircraft search as soon as possible in order to be able to close and place a plane in service before year end of 2024.
So, okay. So I've got a $600,000 tax bill. I buy $1 million jet. If I buy it in 2024, I can write off all that tax bill, 60% of $1 million.
Of course, call me to confirm the facts related to your business.
Right, and how sure. An oversimplification and the math on it, that's close to what the math would roughly be.
Yeah, the napkin math would be if you have $600,000 of taxable income in your business and you go out and buy this $1 million plane, then we could use the bonus depreciation deduction from the plane to offset that $600,000 of taxable income. And the tax savings would be whatever the marginal tax rate is of that income multiplied by the deduction. So we get a substantial tax savings in that scenario. And that's what most of our clients are motivated to do. The fourth quarter of the year is our busiest time of year by far because our clients are very motivated to depreciate a plane this tax year before year end.
Now, if next year I buy $1 million jet and I have a $600,000 taxable income, I'm only going to be able to write off 40% of the million, or $400,000 to offset that 600. And again, we're not losing the rest of it, but just for that year, the max I can go against it would be the 40%.
40% plus the first year of 5-year makers. But yes, we'll have a smaller deduction in 2025 unless there's legislative change. So as you mentioned, there's nothing being lost as long as this taxpayer has substantial incomes going into the future. then they'll still get to utilize that deduction in future years, but we don't get as much immediate benefit in 2025.
All right, well, that's great. So I'm going to go ahead. I'm going to set up my pre-buy, and I'm scheduled to close on December 31st. And I'm going to take my first flight on New Year's Day. To take my family out to treat themselves for a brand new me, new jet 2025. Is there any problem with that, buying my jet on December 31st, but I don't fly it until the next day?
Optimally, we do need to close before year end in 2024. There's no doubt about that. And then optimally, we would have one or more business flights in 2024 to firmly place the plane in service for tax purposes. However, that's not an absolute requirement to place the plane in service. The requirement is that the plane has to be in a state of readiness and availability for its intended use. That actually is quite gray. There's a lot of nuance there. Definitely call me or my firm to discuss, and we can make sure that you have a good plan to place the plane in service prior to year end. But if we can, we like to have one or more business flights prior to year end. And it's important that that's a business flight too. If we have one entertainment flight prior to year end, and that's the only use of the plane in 2024, our business use percentage in 2024 is zero. So we wouldn't be able to take a deduction.
Now,
so
I think, yeah, that's really important. I think you guys outlined this, right? So what does it mean to qualify for the depreciation? We need a binding contract to purchase by the 31st. We need a deposit of either 10% or 100 grand, the lesser of. And we need to take delivery and placing the aircraft in service by December 20. And that's kind of what we're talking about right now. And then the depreciation deduction will be taken. Okay, so this was a little confusing to me. So I guess I was getting confused because they started throwing out 2020, buy by the 24th to qualify for depreciation in 2025. And then taxes always talk about my 2025 taxes are actually for the 2024 year. Can you just so I'm clear, I was a little confused on the dates that this thing is that your blog is talking about. Can you clear that up for me?
This is a completely separate provision that relates to placing an order for a new plane this year to deliver in 2025. In that type of scenario, we actually get a 1-year delay in the phase down of the bonus depreciation rate. So you could take 60% bonus depreciation in 2025 for an aircraft delivering in 2025 and being placed in service in 2025 if you place the order with these requirements.
Aircraft order. Okay. Oh, this is for the deliveries. Oh, is this another? Am I on the wrong blog?
This is another one.
I was on the wrong blog the whole stinking time. You should have said something, dude. Okay, this is what we were originally talking about. Okay. Yes, 100% says 2017. Okay. Gotcha. Okay, so the biggest thing, I imagine it's similar to take the deduction. You need a binding contract. You need to prove that you closed on the airplane. The aircraft, I assume, basically.
Yeah, of course, we do need to close on the plane. That needs to be done if we're wanting to take 68%. In 2024, that needs to be September 30th or prior. After September 30th, it'd be about 62%. We need to close on the plane and place it in service. So that binding contract language and deposit language more so applies to getting that 1-year delay in the phase down. Used aircraft buyers, not as relevant.
Gotcha. Okay. Gotcha. All right. Well, great. So I'm about to close. I'm about to offset my taxes for the end of the year. But the conversation that this always comes back to for you and me is, what are the taxes due at closing? Let's run through it again. So here's my best pitch when I'm talking to buyers and sellers. Listen, taxes, I'm going to do step by step. Taxes are the responsibility of the seller. True or false?
Taxes are generally the responsibility of the buyer.
The buyer? Come on.
The buyer. It can be a bit more nuanced than that in some cases, but generally speaking, sales tax and use tax and personal property tax is the responsibility of the buyer after they buy the plane. And it is
so I buy the plane, I have to pay the tax to Florida and to whatever state.
Correct. The buyer would have that responsibility to the state where closing occurs if they don't meet an exemption, and their home state where they base the plane, where they may have a use
Right.
tax liability.
So that's okay. Okay. So premise number one is taxes are the responsibility of the buyer. So if nothing happens, whoever is owed taxes, they're going to come after the buyer.
Correct. And the exception to that rule is if we close in a state where the seller has a sales tax account, they may have an obligation to collect that sales tax.
Oh, that's where I got confused.
Unless presented with an exemption. Otherwise, it's responsibility.
Okay. Is Florida one of those states where the seller has the responsibility to collect?
If they have a Florida sales tax account, they would have an obligation to collect sales tax from the buyer if closing occurs in Florida as a Florida registered dealer.
Gotcha. Okay.
If closing is in a neutral state, generally that liability just rests with the buyer and the responsibility rests with the buyer.
Okay. Okay. So the responsibility rests with the buyer. I'm with you so far. Now, so usually and that makes sense because usually it's the buyer that's asking to close somewhere else. The seller's just like, take my debt. They don't
Right.
care. So it's usually the buyer. Okay, that makes more sense. So the buyer's the one that's trying to get a tax-friendly place. Now, we have these things called flyaway states. What is that?
A flyaway state is a state that has an exemption that essentially carves out a scenario where a buyer is buying a plane, but they're not going to base, hangar, utilize, register the plane in that state. They're just picking up the plane and leaving. So the state says, hey, you don't owe us sales tax in that scenario. Lots of states have that type of flyaway exemption, but there are some that don't. So it is a very important part of the tax planning process to select a tax-friendly state for closing. Fortunately, there's a lot of them. So if pre-buy is occurring in a state that is not tax-friendly for closing and they don't have a flyaway exemption, we will help the buyer identify a nearby tax-friendly state to reposition the plane to for closing.
So if you have a seller up north, let's say Massachusetts, you've got a buyer elsewhere that wants to close in South Carolina. I don't know if I guess let me preface this. I don't know if they want to close in South Carolina because it's A, tax friendly, or B, a flyaway state, or B or C, both, or D, not none of the other. I don't know if are they related. Is the flyaway state necessarily a tax friendly state, or it's just that you can get it out of there easily, but it doesn't necessarily mean it would be, because I imagine South Carolina has like some kind of special sauce. Everybody wants to close there.
A flyaway state is tax friendly if the buyer can meet that flyaway exemption, but there are states that are tax friendly without being a flyaway state. The reason that South Carolina is tax friendly for closing is not because it has a flyaway exemption, but rather that its sales tax is capped at $500. So obviously a de minimis amount when it comes to an aircraft transaction. So lots of aircraft acquisitions close in South Carolina for that reason.
Okay. So I'm a buyer. So it doesn't matter that the planes it matters that the planes in Florida getting the pre-buy, because I can leave Florida and close on it without having to, oh no, the point of the flyaway exemption is because I can close and go away and Florida's not going to chase me. That's the point of the flyaway. I'm going to close here and they're not going to chase me, but I might still be on the hook for wherever I close. Like I might go to, where's a terrible place? New York. I just guessing. I might fly, to New York and get really smacked over the head, or California and get smacked over the head with tax if I close there.
Correct. The closing location is what matters. Now, surprisingly, New York is actually friendly. They don't have sales or use tax on aircraft.
Oh, okay.
California does have a flyaway exemption. It's not the best flyaway exemption, though.
Okay.
Don't need to go too deep into the weeds on that one, but both are friendlier than you would think.
Okay.
Places that are not friendly to close, that don't have flyaway exemptions, that is an important piece to consider. And what matters is where we close, not necessarily where pre-buy is. So pre-buy can take place in Ohio, for example, which doesn't have a flyaway exemption. That's not an issue from a tax perspective, as long as we can reposition the plane from Ohio post pre-buy, but pre-closing to another state that does have an exemption that we can meet.
Yep.
Or otherwise we're able to be exempt from sales tax. So for example, pre-buys that happen in Ohio, it's very common for the plane to be repositioned to Indiana for closing because Indiana has a friendly flyaway exemption.
Right. Now I go to South Carolina, I go to Indiana, I pay my tax on the my sales tax on the transaction. But now I need to worry about, as the buyer, where I'm going to be using the aircraft. Is that right?
That's correct. So we close on the plane in a sales tax friendly state that we help you identify. We meet a flyaway exemption or otherwise close somewhere that has minimal sales tax or doesn't have sales tax on aircraft or doesn't have sales tax at all. But then the plane comes back to the home state where the buyer is going to base that plane and hangar it and utilize it. So let's say, for the sake of this example, it's Florida where you're based, Tom. When the plane comes back to Florida, even if we closed in Indiana, which was sales tax friendly, Florida would like to collect use tax on the plane unless we meet some sort of exemption. And that use tax is 6% plus a little bit of local. So if it's $1 million plane, a little over $60,000. So that's obviously a very important planning topic amongst our client base. And generally, in most states, we do have use tax planning options to defer or be exempt from that liability. It varies widely from state to state. You absolutely, if you're an aircraft buyer, you should be calling a firm like mine or similar to talk about what your options are, depending on your facts, how you plan to utilize the plane. And that planning does need to be done prior to closing. So very worthwhile to check into those options.
Is use tax one time, like after you buy it that one time, or is it every year?
The former. So it's a one-time tax. Use tax is kind of brother sister with sales tax.
So they're going to get you.
It's that one-time tax. Sales tax is based on where closing occurs. Use tax is based on where the aircraft is based, hangared, and utilized. There's also
that's usually something that the tax is like. So when do they? Do is probably the wrong word, but I feel like I sold my plane and I didn't talk to someone like you, which I should have. And then it was like 9 months later that I get, in the mail, hey, by the way, Florida's coming after you for you sold it. Did you collect the money? And like, where's our cut from your sale? Like when do people find out about this? I mean, imagine you deal with nightmare situations where a guy buys a jet and then like 6 to 9 months later, it's like, here's your bill for $60,000.
Yeah, it varies from state to state when that liability is due, but generally it's pretty soon after the aircraft is brought back to the home state. However, lots of buyers, if they don't work with us or someone like us, is unaware of this liability. So as you mentioned, they get blindsided. They close on the plane. Let's just say they close on the plane in Montana, which famously does not have sales or use tax. And then they bring the plane back to their home state of, let's say, California in this hypothetical. So they think, oh, I don't know any sales tax. I closed on the plane in Montana.
Right.
And then they get a letter from California saying, hey, we see that your plane's based in California. Why have you not paid us use tax on the purchase price of the plane, which in California is generally around 10%. So they want $100,000. And if the buyer hasn't met a use tax exemption and is based in the plane in California, they are going to owe that liability. So
and they can't prove that after they close, or it's just more difficult for you guys?
After they close, if they happen to have met an exemption or are still within the window to meet an exemption, we can help them document that. So if you get that letter, do give us a call and we can see what the options are at that point in time. But your options are going to be a lot more limited, and it's going to be trickier at that point at a minimum, versus the optimal path to proceed is get a plan in place before you close and understand what all your obligations are, what the options are to minimize or defer those obligations to the extent possible prior to closing.
Always learning something from you, KJ. I really appreciate it. I'm glad we had a chance to share, and definitely, check out aviationtaxconsultants.com. Not just, if you need to contact them for their services, but they do have an active blog. Any resources on here you want to call our attention to? I noticed you got some stuff going on over here. Oh, look at all these exemption experts. Look at that. Okay. Yeah. Anything else you guys want to share on here?
No, feel free to browse, and as questions arise, always feel free to reach out via email or phone call as questions pop up. The easiest way to get answers is to give us a call, and we can talk about your specific facts and what we can potentially do to help. The other item that we did not discuss on this podcast is personal property tax, which is a separate tax from use tax. That's the annual liability.
Oh, God.
Some states impose personal property tax on aircraft. Other states do not. Florida, for example, your home state, Tom, they do not impose personal property tax on aircraft, which is wonderful. Other states, it can be fairly substantial, in the vicinity of 1%, 2%, even close to 2.5% of the value of the plane per year.
All right. Well, definitely give you guys a buzz for sure as people are preparing to buy, especially coming into this fourth quarter. So yeah, definitely check out Aviation Tax Consultants. And KJ, thank you once again so much for being on the podcast today.
Yeah, absolutely. Thanks again for having me on.